Welcome to BISP solution. So we are going to start a new series on learning the Oracle Account Reconciliation Cloud Services, ARCS. So my name is Anand, and we are going to learn about this ARCS tool of Oracle. So what does Oracle Account Reconciliation Cloud Service means? Here, as we can see, uh, we have, the word reconciliation. So the tool is made for reconciling the accounts, the financial statements. So to begin with this, we will just take an overview of the reconciliation, its need, and why it is how it will benefit the organization, and why the reconciliation is needed. So then we will come to this ARCS tool of this Oracle. So what basically reconciliation mean? What is the need of this reconciliation? Uh, in a common language, the reconciliation means the comparing the two things, to two different set of data in our day-to-day life. We can just say we can compare our monthly expenses from one month to another, or just calculate uh, the income or the different expenses which we are incurring. So but from the business perspective, what does this financial reconciliation mean? So it means it is basically an accounting process by which two different data sets are compared to verify that the information within them is accurate. So we do this reconciliation so that the information we have is accurate, it is proper. And finance reconciliation, it is the process of comparing financial records to make sure they are correct. It is an integral part of company's decision. So this reconciliation becomes one of the important or a activity in a financial close of every organization. So and it plays a very important role, a pivotal role in ensuring the reliability and accuracy of a business financial records. And it also ensures that there is no unusual transaction which has occurred either due to fraud or due to some other manual or manual or accounting error, mistake or error. So basically, when we see in a business for an organization, the books are kept, the books are maintained on a double entry system. So if we can say, double entry system is a bookkeeping system in which the transaction effects at least two accounts and maintain a balance between debits and credits. So what does it means? Basically, when we make an entry in an organization, so basically there are two line item in an entry. So first one is, say, it is a debit, and the second one is a credit. So that's why it means, so we have to pass a two entry to make a transaction in our books of accounts. So the very basis of double entry accounting, it itself is an internal reconciliation. Each entry must have debit and credits that equal. So what does it mean basically? Suppose if we are passing an entry such as receiving an payment from an customer, say for 1000, so it will be debited, and say it is 1000. So what we are doing, we are passing basically two entries, one in the bank and other one is in the customer. So these two entry must be matched to make its reconciliation. If this is not reconciled, then there is some error in it. Then there is some error in it. So this is the very logic behind it. So we make a two line item in a transaction, or there may be the line items may be more, but the amount should be balanced. So whatever is the total of debit, it must be equal to credit. So this is the two. So in it, so that's why it means here the double entry is it is itself an internal reconciliation. So when we see in a larger perspective for this double entry equation, the formula here is, the concept here is, asset is equal to liability plus equity. That is, whatever we entry we made, they are made in two accounts, and after at the end of the period, so all the assets is equal to liability plus equity, and these transactions are recorded through general entries that increase or decrease the amount of money in different account depending upon the type of transaction. That is, with double entry, under this double entry accounting, each general entry updates at least two accounts in the company's general ledger using an equal balance of debit and credit. So this is the same thing which I explained here. This is the bank must equal to the debit and credit amount must be equal. This is the rule for this double entry equation, and it balances our statement. So rules followed for this double entry: every transaction must be recorded in two or more accounts. Okay, at least there must be two accounts, or there can be more accounts. For each transaction, the total amount debited must equal the total amount credited. Only then it will be called as a double entry and it will be reconciled. So this is the what is then why this is the need of RECO. When a comparison, so this is the part when we make the entries following the double entry equation. But generally when the comparison is made between ledger or document, say for example between a bank balance and a firm's cash book, the two balances do not tally. The total balances may not be tally. So hence for this purpose we have to first ascertain the causes of this difference. Maybe say for example the bank balance may be showing as a 2000 and a cash balance is showing as 1500. So the total balance is a different one. So we have to first ascertain the causes of these differences, and by identifying them we prepare a statement called bank reconciliation statement to reconcile the two balances. Okay, so if there is any difference, that is 1500 and 2000, so we will make a statement to identify what are the why this difference is coming. So the difference is caused mainly by timing differences on recording the transactions. So out of the total causes, reasons which causes difference, so they have been grouped under two categories basically. Timing difference on recording the transaction. There is often a difference which is caused by time gap in recording the transaction relating to either to payment or receipt. Maybe we may have, for example, the customer has credited your account in the bank account on the 31st, on the last day of the month, but in absence of any information, we have not credited that customer's account in our books. So the difference will arise. So the bank balance will be higher, while the cash balance in our books, in our general ledger, bank balance in our general ledger will be a lower one. So this is known as the timing differences. So error made by business or by bank. So the error can be made either by the bank or by the business. So difference between two balances may be accounted for by an error on the part of bank or in the cash, or an error in the cash book of the business. That is, we may there may be a error in recording the transaction. Maybe we may make the entry of say for example we have received an amount of rupees 1550. We may record it as 1500. So it will difference our between the bank and the balances. So the ledgers will not be match equally. So this is meant by these errors made by the bank or other by the cash balance. So it can be caused by either of the side. So when there is a difference, we need to identify this reason and rectify them. Without reconciliation, our figures will not be proper, will not be accurate. So what are the different benefits of this reconciliation? So it has many benefits which can help a business. So we are talking about from the business perspective. So it helps in detecting errors in the data entry. Just now we have discussed. We may make some error in recording the transaction, in entering the inputting the amount. So which may be identified with the help of this reconciliation. So correcting time discrepancy with bank transaction fees and interest. Similarly, we have seen the timing difference also. Bank credit our account on the last day of the month, while we take that account in the next month. So there will be a timing difference. So it will also cause the reason. And also similarly, the bank may charge some fees or interest to our account, which may not be able to take into account on the same date or in the same period. So that may also cause the difference. And it basically ensures the accuracy and validity of financial statement produced by the business. So if there is an error, or there has been an inflated amount or an underrated amount, so it will not give us a valid picture, the accurate financial statement figures. Detection of fraud. Similarly, one can have a manipulately or intentionally make a fraud, or make some changes, or do not make an entry with a higher amount, or maybe with a lesser amount, or we may not show the collection of a particular receivables. So that can also be easily detected through this reconciliation. And it is basically, and comply with regular, it is basically a requirement under by the authorities that the reconciliation must have been done. Otherwise, you are subject to penalization. And it is also required for preparation of tax filing. So all these benefits we can get, and we can have this benefits by reconciling the our accounts, books of accounts. So what are the different approaches of these reconciliations? Now we have make an entry, we have identified the reasons of different causes, and how we can approach the what would have been our approach to for this reconciliation. So basically, so there are different approaches to perform a reconciliation. The mostly basic, the common types of reconciliation are document review, and the second one is the analytics. So document review is an desktop review, and not an in-depth review, while the analytical review involves in-depth knowledge, in-depth analysis of the errors. So under the document review, it involves the comparing the financial records with source documents, and also examining the transaction in the business own financial record and comparing those with source document. What does it mean? What the entry which we have made, or the transaction which we have entered in our books, they have been verified, or they have been re-examined or reconciled with the source document. On that basis, the basis on which that transaction is made, such as the receipt, the invoices, or the statement which we get from the third party or from the bank. Similarly, for entering the transaction of purchase, we will the basic document here is the invoices. And under the analytical review, it analyzes the historical data also, right? In-depth knowledge of the transaction and also the historical data to detect any deviation or irregularities. So this is done by performing a historical analysis and comparing this to current data. So on this basis, we have the past data of this for a particular transaction. So we will compare our current transaction amount with the historical data, the last month or the last to last year available data, to find out the variances or the reasons. So if a present accounting figures are widely different from projection made, and similarly, if a present accounting figures are widely different from projection made from historical data, this may be sign irregularities. Similarly, we have made some projection or created a some budget or the forecast for a particular expenses, and in actual there is a wide gap in that expenses or the receivables. There may be a so we have to identify, so we are supposed to identify the reason for this differences. So there may be some it may be a sign of irregularities, and also there may be some genuine reason for this mismatch of this figure. So these are the two, basically document review and analytical review. So in so in this analytical review, we make a difference, we make a in-depth analysis of the transactions variances. And similarly, if we talk about the consolidation, what I'm the purpose behind this explaining this all this activity here, mine is to inform you, to inform that all this activity, that is the document review or the analytical review, is being done by the ARCS. So all this activity, that is the a preliminary review or the analytical review, is facilitated by the ARCS tools. So what are the basically the steps involved in this? So under this we have to just first we have to consolidate. So under this we collect all the relevant documents. We gather all the relevant document, invoices, ledgers, and for which reco is to be done. For example, the purchases, payment, expenses. So in this, so we just collect or the consolidate, gather all the relevant document basis which we can related to the ledger or the accounts for which the reconciliation is to be done. Then we do a comparison of this. So under this comparison, we compare the transactions of internal ledger with those external documents such as bank statement or the third-party ledger. It helps us to spot the discrepancy and errors. If there has been any discrepancy, we will be able to identify it under this step. Second step, compare. Under this we compare just, and under the third step, in this step we identify and recognize error. So earlier we make a comparison and identify those errors, and under this third step we once it is identified, we recognize those errors, whether they are genuine or they have been what are those reasons behind these errors or the variances. So in this step we identify and recognize errors, duplicate errors or the duplicate entry or the wrong transaction, calculation mistake, etc., or missing entries. Error caused in recording which has resulted in a recording of a wrong recording of a transaction. Then the next step involved, once identification is done for difference, it is what it is. So the next step is to correct them in ledger. So the confirm. So confirm here means we have to just rectify it in our books of accounts. Then comes the last step in this. We balance record. After addressing discrepancy and fixing error, next is to ensure balance and accurate the record, and review the data and confirming adjusted numbers match to overall financial statement. So we have completed, once we complete all these steps, so we just address and fix. After fixing that error, the next is to ensure that the balances are accurate. The balances are accurate and provide us a true and fair picture of our financial statement. So the results are as per our expectation. So the what we are expecting are produced by our with the help of this reconciliation. So we just review the data and confirm adjusted numbers match the overall financial statement. So what are the basic approach under this approach? By using this basics approach, this one, these three basics, under this basic the approach, uh, the most commonly performed reconciliation under different context in a business. So by using the basic approach, financial reconciliation is performed for different context in a business. So different context here means the bank reconciliation. And that is, it compares own financial statements with the bank statement to identify time delay in deposit fees. Similarly, petty cash differences. It aims to ensure that petty cash funds are ensured are being spent as per internal guidelines and policies and documentation. And policies and documentation are being properly followed for transaction with receipts and invoices. So that the basic and the analytical approach is used for this bank reconciliation and also for petty cash and also for this general ledger. So the general ledgers are the key source of financial record with the help of which reconciliation are performed in most of the cases. So the general ledger here means the comparison of receivables or the vendors or the intercompany transactions. So those data will come from general ledger. So this approach, the analytical or the document overview is overview analysis is being done for either for general ledgers and also for general ledgers also. So how this reconciliation is made, then we have two methods, that is manual reconciliation or by through automated reconciliation. So we will be having this approach, the ARCS, for automated reconciliation. So before moving to that, we will just have an overview of the manual reconciliation, the disadvantages of this manual reconciliation. Though the manual reconciliation is basically performed with the help of this spreadsheet, that is this Excel or the similar document, which are with the help of which a reconciliation is made for different accounts. So spreadsheets serve many essential functions for individual to organize a personal budget, accumulate important figure and more. So here the spreadsheet or the Excel is useful for a low volume transaction or a smaller or for a personal purpose, but at a point of time, after a point of time, the use of spreadsheet only becomes burdensome when the calculation becomes larger and the data becomes take a larger shape. And basically the spreadsheets were created in 1980s to manage the budget of a 4-person household, not of an organization financial reporting. Using spreadsheet to perform your organization balance sheet reconciliation present many challenges and risks. Similarly, in the current scenario, use of Excel with a huge data and much complexity in the organization structure and in the transaction, spreadsheet or the manual reconciliation is a challenging task and involves a lot of risk. So what are the basically those risks? So there may be an error, though it is unuseful. So the spreadsheet should be used as a support, should be a supplementary tool in the reconciliation process rather than the primary tool to be used for data. So the and the error are highly prone to errors. So it may contain error in some manner which can be identified, which we can easily, some of them we can identify, but while some of them we cannot be able to identify. So they are highly prone to errors. So there is a lack of visibility and control. It leads to lack of visibility and control. Any changes or adjustment made during the close are often hard to catch until the close cycle is completed. When these changes are caught and corrected after that close, it lead to inaccurate. So for example, if we have not been able to identify the differences or the adjustment within the scheduled time, it may lead to a wrong presentation of reporting of financials. And lack of standard format and documentation when used by different peoples of organization. The Excel file or the different formats have been used by in an organization. In an organization, different formats were used for the same task, maybe. So the spreadsheet shared amongst colleagues and financial leadership uh, use their own layout, and they may broke calculations, or may they put in or they insert some column rows as per their convenience, and which may lead to the broken calculation and can cause bottlenecks and error in the balance sheet reconciliation. So the compilation of different format and calculation, it leads to improper result. So there is no standard format and documentation, but we can have this standard format and documentation in our ARCS tool. So the last one, the not the last, the fourth one is the improper assessment and account risk. So with spreadsheet and other manual methods of reconciliation, the assessment of account risk is difficult. Instead of prioritizing giving priority to high risk account, the focus is spread equally across all balance sheet accounts, which increases the organization's chance to a risk factor that might missed in a key account. That is the focus of an often the personal of a person, the resource is diverted to an less important accounts rather than the more important task in the closing process. So it has so it lacks the improper assessment. We may be involved in identifying the error, and it is consuming a lot of time of identifying those errors and resulting in a delay in reconciliation. So what are the different types of the reconciliation we made? So basically, we have discussed this earlier also, but in a detailed view. The bank reconciliation involves, so we do a bank reconciliation. This is the most common type of reconciliation made in an organization. So it involves the business reconciling its own financial statement with the statement it received from the bank. It is the bank reconciliation, the most common reconciliation method practice. A vendor reconciliation. Under this, we compare statements provided by the vendor or supplier with the business own accounts payable ledger. That is a vendor reconciliation. The customer reconciliation, we compare the statement provided by the customer with those that is maintained by ourselves to reconcile the activity, to reconcile the transaction, the differences. So there may be intercompany reconciliation, in which the reconciling statements and transaction between units, divisions, or subsidiaries of the same parent company. That is intercompany reconciliation. It may be within entity, units, department, or some other subsidiaries. Business specific reconciliation, it involves reconciliation of accounts in a specific business unit, such as the stock, inventory, or expenses reconciliation. So within an organization, we can have this business specific reconciliation. That is a business process reconciliation. That is the most common one is the stock, inventory, and the expenses reconciliation. The reconciliation of actual expenses with those of forecast or the budgeted. Credit card reconciliation compares purchase receipt with credit card statement provided by the credit card company. So similarly, this is basically the same with that of bank reconciliation. Now we will come to this account reconciliation. So we have seen the reconciliation need, why it is needed, and why the manual reconciliation, if we do, what are the different drawbacks of a manual reconciliation. So when we talk about this ARCS, account reconciliation cloud service, basically account reconciliation is a purpose built business process available in the Oracle Fusion Cloud API designed to manage the global reconciliation process. So it basically provides a real-time visibility into the performance of reconciliation, ensuring that all reconciliation are prepared and properly qualified. So it helps company to streamline and optimize performance by automating certain reconciliation tasks, including high volume transactional. So the whatever the drawbacks which we have just seen in this session can be curtailed or can be managed with the help of this ARCS tool, which is an part of this Oracle Fusion Cloud EPM, which is a part of the EPM tool of Oracle. So I will just, so this is basically the ARCS tool. So we will just first go and see that the application here, the ARCS tool. So this is basically our application through which we will perform the reconciliation of different accounts. So when we talk about this reconciliation, account reconciliation, so what are the different key features which it provides, through which we can avail? So it's basically an auto reconciliation. It provides the automatic reconciliation and the reconciliation of the rules. It provides automatic reconciliation. For reconciliation purpose, for reconciliation, it defines certain rules which enables an automatic reconciliation of transaction. Similarly, then we have this efficiency and accuracy is quite significant for client. So it provides us the efficiency and the accuracy is significant for a client. So it provides an accurate result of the reconciliation transactions. So then we have this flexible formats. It offers a pre-built formats to meet the standard requirement, and also we can build some custom format based on clients' needs and business practices. So it has the tool application has the pre-built format, and also we can build the custom format based on our requirement, internal requirement. So it will not be like that the individual persons will be using their own format to reconcile. Basically this one, like a formatted spreadsheet broken into. This will not happen in case of in ARCS. So from there we will just go and see. We'll show you the different formats under the configuration. Under the configuration, we have certain tools. We will go and learn each this aspect of this application. But for our this format, I will just show you the format layout. So now you can see these are the different format which we can assign in our profile for the reconciliation purpose. So now you can see we have this a format named as accounts payable, accounts receivable, then we have accrual, then we have bank reconciliation, then we have current asset and current liability. We have different formats. So we can use this pre-built formats for our reconciliation purpose. So we don't have to create a fresh format for it. For this basics, all this common reconciliation, for all this common reconciliation, all these formats are inbuilt in this applications. So in this Now you can see we have this ledger and the third party ledger. Then we have this source system and the subsystem. The source system in which we are comparing the two ledgers here, the general ledger and the third party subsidiary ledger, or we can say and as per our requirement, we can have this instruction tab. We can provide a instruction to the users, to the end users for doing this reconciliation. Then we can have these attributes. So this attribute helps us to create a detailed information. We can have a different attributes in which we can capture the different type of information or the data which we require. So if we click on this plus symbol, now you can see we have this, all these attributes we can assign to a format as per our requirement. So what is the accounting date, or what is the adjustment date, or what is the say payment date or the receive date, which we can assign in this. That is the invoice number, intercompany. If the intercompany transaction was there, then we can have this attribute assigned to that format as per our need. Okay. Then we have these questions. Then we can have this facility of approving, of asking the questions to a format. There may be the manager or the reviewer may be interested in asking some questions. So we can have this question assigned to this format. Then we have these rules. So then we have these rules, which is a very useful feature of this application. Under these rules, we have the different rules. 9 rules are pre-built in it. With the help of these rules, we can easily filter our transaction and reconcile the same at a glance, at a time. So we have to just apply that rule in this format. So we will learn all this in our coming sessions. Then we have this history tab. So this is nothing but it gives us a summary of the changes or the modification we made to this format. So what I mean to say here is we have the pre-built format. Likewise, we can create the format here as per our requirement. Okay. See, this is the tracking one. Source system reconciliation. Then we can have this rules frame for this purpose. So it provides us a pre-built format and custom format. Also reporting and analytics. So it involves a operational aspect, that is how the process is working, how the reconcile are getting done, what is aging, and etc. So the operational aspect and the compliance risk aspect. So there are two aspects involved in this. So the compliance aspect focuses more on how the organization is doing in policy versus procedure. So the first one is the operational, how the workings going on, what is the status, where is the delay, what are the bottleneck in the reconciliation that we can have, that we can achieve through. It is provided under the operational aspect, and it covers that operational aspect and also the compliance aspect, which is the important one, whether the reconciliation is being done, all the policies or the SOPs meant for this are being followed or not. And similarly, then we have this variance analysis. The variance analysis process can be automated by identifying outliers and explanation on unexpected variance over period of time. So it provides us a variance analysis also. So we can have the variance between the different periods, between from one ledger to the other ledger, or for a multiple period of time. So we can have achieve that, or we can we will be able to know the variances analysis. So what are the different reasons for the differences? Then variances which are within limits can be automatically certified. And also the one of the feature in this, if the variances they are of small in nature, they are within the tolerance limit, it can be easily, with the help of this rule, we can just automatically certify it. It will automatically approve that reconciliation if that variance is within the limit. So this is the one of the facility which is available in this ARCS, in this ARCS tool. So for example, now we will go to this profiles. I will just show you what I mean to say here. Now you can see this is the profile in which auto reconciliation option is there here. So under this method we have this operation, the balance is 0. So the reconciliation will not be completed unless and until the balances becomes 0. That is the ledger and subledger. The balances, the difference between ledger and subledger becomes 0. If it is not 0, it will not do a reconciliation. If it is not possible, then we have this balance is 0 and no activity. Though the balance is there and no activity is required, then we can have this option. Then we have this balance match with percentage tolerance. That is, though the balance is not 0, the difference is not 0, but there has been a minor difference. Say, so we can assign a percentage tolerance to which it can consider it as a reconcile. And similarly the balance match, so in case of percentage we can also provide an amount or the value so that it can match the reconciliation. So this is basically the feature in which through which we can variance analysis can be made. Now under this reconciliation, this ARCS, reconciliation. So all this activity of this reconciliation revolves around the two method, the two module basically. So the two module are reconciliation compliances and the transaction matching. So the account reconciliation basically perform all its activity using the two module and the method involved in this. So what are the two modules? So the first module is the reconciliation compliances and the other one is the transaction matching. So under the reconciliation compliances we have the three methods involved in it. So first one is the balance comparison, the second one is the account analysis, and the third one is the variance analysis. So for the balance comparison for reconciliation of balances between ledger and subledger, balances between two ledgers. Account analysis means for explanation of account analysis. Account analysis here means we do a analysis of a particular account. We do a in-depth analysis of a particular account. And similarly in the variance analysis, for variances in account balances for over a multiple periods. As I said, we can have a variance analysis in this. We made a comparison of a particular balance for a multiple period. So these three are the method, balance comparison, reconciliation compliances method. And we have this another module, the transaction matching module. Under this we have three modules. Account analysis with transaction matching, that is this account analysis is matched with transaction matching. Balance comparison with transaction matching, that is this balance comparison with transaction matching, in which balance comparison is matched with transaction matching and account analysis is matched with transaction matching and the individual transaction matching method. So we will use this method, apply this method for our reconciliation. So we will just go to our profile and we'll show you under this configuration. Sorry. Now you can see for the different methods, for the different formats, we have assigned some method in. That is, this is the balance comparison. Then we have this balance comparison. Then we have this account analysis method. This is the account analysis method. And then we have this balance comparison with transaction matching. This is this method. Beside this, no other method is being used here. Then we have this account analysis with transaction matching. This is the first method under the transaction matching. Then we have this variance analysis. Variance analysis, which is a part of reconciliation compliances. So all this transaction, this is the transaction matching only. This one is the transaction. So under this reconciliation, we will use only this 6 method for reconciling purpose. So all these are the profiles. We will go and learn about making how we can create this profile and the configuration in our coming sessions. So today we will just do we will take an overview and a basic introduction of the application and the concept of it. So when we talk about this in length of the different method which we have used for this reconciliation compliance. For this, under this reconciliation compliance, we have 3 methods. Balance comparison. So you can say, as the name suggests, it compares balances. So the comparison may be between 2 accounts or a single account. So the balance comparison, in this we compare the total balances between 2 ledgers between 2 accounts or a single account. Okay. So if reconciliation involves sub ledger, then reconciliation between general ledger and sub ledger balance. For example, accounts receivable and payable, fixed asset and cash and bank balance. So the comparison may have between. So it may involve a single account or a double account. If there is in some sub ledger is involved, then we make a comparison between general ledger and its sub ledger. Okay. So the comparison of account receivable with the details provided by the third party, and also the fixed asset reconciliation, the reconciliation of a group of a fixed asset with its members different. And similarly, the cash and bank reconciliation also falls under this category, under this method. Then we have this account analysis. If no sub ledger is there, only one account is available, then we use account analysis method by explaining or by adjusting the balances of one account. So if we have to do an analysis or the reconciliation of where the only one account is available, then we use this account analysis method. So in which we do a explanation or adjustment or the reconciliation of only one account. Say for example, comparing spreadsheet calculation with general ledger of prepaid, accurate expenses, unidentified, unapplied receipt, note receivable, factor receipt. That is, we have a supporting document or a supporting spreadsheet calculation related to prepaid, which have been available in our ledgers, in our books of accounts. So we compare those spreadsheet calculation with our ledger. So here we are comparing only one account. That's why we call it as an account analysis. And the third one is the variance analysis. In this, we compare a current month balance with prior month balance on monthly, quarterly, and yearly basis. For example, expense comparison for a multiple period, maybe for a quarter, for the last month or the last year, YTD, year to year, and QTD also. So for the second module, that is transaction matching module. So Further to comparing balances, organization also like to match the transaction that form the balances. So under the balance comparison, we compare only the closing balance, the balances which are coming. But what about those transactions which are making that balances? By adding that transaction, we are calculating some balances. So what? So for comparing that transaction, we use this transaction matching. So here transaction matching module is handy to simplify the complex reconciliation involving large volume of transaction and line items. That is, here we are comparing the different transaction or the line items of a general ledger. So it does the thorough review of the accounts of ledger. So it make a detailed analysis and the review of the accounts of ledgers. For example, cash and bank reconciliation, suspense and clearing, credit card receivables. So in this, we may be having a large number of voluminous transaction in our bank statement and also in our cash book. So we will be comparing these two, the transaction item. So basically, the basic step involved in this, we first load transaction from more than one source. So we are talking about the steps which are involved in this application, in this ARCS application. So we load transaction data into our application from more than one source, that is ledger and sub ledger, and then we run the auto match process. Okay, match the transaction using predefined rules, and under the format we define rules basis which the transactions were matched. Okay, by providing some tolerance limit or by balance zero method or by making it as balance zero. So it helps to, so it match the transaction using that predefined rules. Identify the variance and exception. If some transactions remain unidentified or unadjusted or unexplained, so here we identify those variances. It helps us to identify those, it sort out those transactions. And in the last step, we provide the reason for variance and expenses for exceptions provide under this. Okay, then we have this transaction matching can also be used for reconciliation of non-balance sheet items such as operational reimbursement, stock settlements, etc. Not only for the financial transaction but also for the non-financial transaction or the non-balance sheet items also, maybe reimbursement or the stock settlements, etc. Okay, this is not the proper slide. Okay, so this is basically about the method and the modules which we will be using in our application. So by using this method, we will be doing a reconciliation. So for that's all for our today's session. So we have taken an overview of the reconciliation, why it is necessary and what are the benefits of doing this reconciliation, and how we can automate all this exercise of this reconciliation, save our time and provide an accurate result in this, and taken an overview, just have a look of the application. So in our next session we will just use we'll work mostly on our application and we'll take one by one all the aspect, all the cards which are available in this application. So and if you have any questions or query, you can just reach out to us on our website www.bispsolutions.com. Okay, so with that we conclude our today's session, and we'll meet again with